In the last few years, discount Chinese shopping apps have become so popular, like Shein and Temu, that SNL, Saturday Night Live, made fun of them about their ultra-low prices and questionable qualities and side effects. In a recent video, now PDD stock losing around 30% of its value today, following arguably very strong second quarter results. Talking about 86% revenue growth, 139% increase in profitability. And what do you make of this? So taking a step back, so PDD, that's the parent company of Pinduoduo and Temu. And Temu, you're talking about ultra low prices. Pinduoduo is a sort of a social commerce model where it's about getting more people in local communities to purchase an item. And if enough people buy it, you get a discount. That's at least the historic model. Looking at the financials, and keep in mind, this is leveraging AI ticker chat, where a lot of the key functionality, chat, completely free to use. So check that out in the link below. Looking at amazing revenue growth. And that's actually what initially got me interested in PDD. When I first bought it, I first bought shares under $20 per share several years ago, back in 2018. I'll talk more about my own personal journey towards the end of this video in terms of, owning PDD over time. I don't own it now, but looking at the share price and looking at the fundamentals, this is very strong revenue growth and incredible improvement in profit margins, and Wall Street was expecting continued strong growth, with their underlying business. So why is it collapsing if their fundamentals were so compelling? Well, I think it comes down to a dark outlook where management was saying, this is from the chairman and co-CEO, talking about, we see many challenges ahead, and it almost seems like the CCP or the Chinese Communist Party is putting pressure on them to reinvest or focus on high quality merchants versus just selling knockoffs, because this must be a record for how many times you can say high quality in just a few paragraphs. I think it's 3 or 4 times here saying high quality. We got to focus on high quality development, high quality merchants, and recognizing, look, our business, Temu has heavy knockoff, less high quality merchants, that will result in pressures on revenue growth, and profitability will also likely be impacted as we invest in the business. Also, we're facing intensified competition and external challenges. Investors don't like this outlook at all. And so the question is, with the stock down 30%, are you able to find a discount, or are you just going to wake up with a bad rash buying their products or buying their stock? Can't vouch for the products. I personally don't shop on Temu. As always, this is not financial advice. Also, quick plug, recently Michael, a premium member, shared the following. So far, the subscription has paid for itself in 3 months. Looking forward to what the future holds. He's talking about unrivaled investing. Come check it out if you're looking for compelling ideas. If you're interested, see the link below. And so this is the reason, in my opinion, why the stock is down so much, is not only this dark outlook, but that management is saying, look, the profit growth in the past few quarters should not be used as long-term guidance. They've talked about effectively over-earning. There's been a mismatch between the business investment and financial reporting cycles. Talk about, in the long run, the decline in profitability is inevitable. No one likes to hear that margins, that you're over-earning and that you're going to be a lot less profitable in the future. And once again, talking about supporting high-quality merchants, they need to make sure high-quality merchants join their platform. They're going to be investing billions of RMB to make sure these high-quality merchants are happy on their platform, and they're going to be making investments in operations and R&D. So they're talking about, look, the profit margins that you've seen, and we've gone from a huge loss to very incredible profit margin. I mean, compare this to Alibaba, compare this to JD, and this is almost best of breed when you look at these types of profit margins. I mean, it's significantly higher than something like a JD.com when you're looking at these operating margins of 20% plus. And Wall Street was expecting, these green bars here, Wall Street was expecting continued profit margin expansion. That's part of the reason why you're seeing this 30% reset, is that no, management's saying that's not happening. If anything, you're going to see significant margin compression in the quarters and years ahead. Now, I think it is worth taking a step back to reflect. At $100 per share, which is where it's roughly trading now, you're talking about around $150 billion market cap. So this is a sizable company. This is still, it's not like Wall Street saying this is going to zero. It's just saying, hey, you need a 30% haircut on this business based on these new dynamics. But $150 billion is still a lot of Wall Street investors saying there's a lot of potential here with this business and there's a lot of value here. And it's not hard to see why. When you see their fundamentals, this is from their most recent press release, and they generated $8 billion in profitability. That's net income in the first 6 months of this year. So even if profitability for the remainder of this year is zero, you can argue that, yeah, it's just not expensive. You might have quality issues, but you're talking about a stock where the fundamentals, the revenue is growing, most recently close to 80%. Even if that decelerates to 20 to 30%, you're still talking about a teens type of earnings multiple. So not a lot of, stocks have that type of profile, growing crazy and trading at a cheap multiple. There are a few, and I've called out, one to my subscribers recently that was growing 30% and trading around 16, 17 times earnings. That's, a beautiful sort of zone to be in. You want to find those types of situations because then you get the potential valuation expansion plus the fundamental growth. So I'm looking at this, and PDD does have that potential because the valuation is not expensive at this current price, and their fundamentals are incredible in terms of what they're reporting. Now, let me share a little bit about why I no longer own PDD. So I first bought shares in PDD back in 2018. At that point, Temu wasn't even on on my radar. It was focused on this social commerce and how they're rapidly taking market share. And, arguably the stock did quite well. At one point it was up roughly 10x in just a couple of years. And maybe I'll make a separate video on how do you find those types of companies where it has that potential for 10x in a couple of years. But I ultimately exited, and I finished closing out of my position when I saw that the founder of Pinduoduo was effectively stepping aside. And this was a red flag for me because one of the key parts of my own investment journey is I want alignment with management. And the alignment with management, that helps to ensure that you're investing for the long term, but also that, hey, if the stock drops 30% in a day, that you're not only in pain, but the founders are. This is their baby. This is what they're excited about. And so when I saw that the founder, Colin Huang, was stepping down, I suspect largely because of Chinese Communist Party, some sort of pressure or them suggesting PDD needed to make some donations, I think he just stepped down. And he stepped down possibly because of CCP pressure, possibly because he was just like, hey, why not cash out? Or he saw that Jack Ma disappeared. And for me, that just became too hard. I do not want, to make investments at this point. And previously I did own Alibaba and I own JD. And at this point, it's just too hard for me, to say, hey, I want to own a stake in a business where the government can so heavily put their finger on the scale and tilt the odds of whether or not you have an attractive return. I want to be in an environment that's conducive to building businesses where entrepreneurs, look, going back to that picture, you could see, he's not a youngster. He's not an old person. He is a youngster. And so when you have, decades of runway ahead of you and the founders leaving, that just bothered me a great deal. Like, he could have built this to be a $1 trillion company someday, but I think it comes down to, do you want to align with, when you're making a bet on PDD, you're implicitly assuming the Chinese Communist Party is not going to rob you in the future. And over time, that just became too hard for me. And so I've pretty much cut all of my China bets. I have one that's an indirect play. That's a company that's trading in Europe, and the Chinese exposure it has, it's effectively trading below liquidation value. And even that, I'm not looking to scale up or get more exposure just because of this China element. So anywho, if this video has been helpful for you, please make a point of hitting that thumbs up, hit that subscribe button, and thank you so much for watching Unrivaled Investing.